Good morning all from Cape Town, South Africa, and welcome to today's webinar focused on how to create dependable and consistent global income in this extremely low interest rate environment. I'm pleased to say that we have 425 participants on the call today, which is really fantastic. If for whatever reason you have any technical difficulties, please don't stress, as we will be recording the session and we'll be sending the recording to everyone. My name is Anthony Palmer, and I'm Group Commercial Director for Carrick, heading up products and investments. For those of you that are new to Carrick, we are a privately owned wealth management firm focused first on the structuring of our clients' wealth, i.e. the most efficient and effective way to actually hold your assets, and then we build bespoke investment solutions to meet our clients' specific needs. Our reach spans across the African continent, and to date, we have offices in South Africa, Zimbabwe, Malawi, and Mauritius, with a strategy to roll out across a further 10 countries in the next 3 to 5 years. We pride ourselves on really understanding our clients' needs, executing an agreed plan, and always being there for our clients and their families through both good times as well as difficult ones. Communication and education are key components of our DNA, and we always try to provide interesting and relevant information to the market. On that note, today I'm joined by leading experts in the fields of structured notes and international property. These are two very different offerings, and we will explore the value propositions of each and how they both create the much sought after income streams that are the subject of today's webinar. Clive is going to be walking us through structured notes. He has almost 30 years of experience in the space, which has historically only been available to institutions and ultra high net worth investors, but is now available on a wider basis through specialist firms such as Carrick. Welcome, Clive, and thank you for your time today. George Radford is vastly experienced in the property sector and will be focusing on returns generated by physically owning your own apartment in your own name. Most of us know and understand property investment, especially the power of producing leveraged returns through low interest rate mortgages. And I'm looking forward to getting an update on what is currently going on in the sector, what opportunities are available, and of course, what rental yields and capital appreciation can be achieved. George, thanks for your time today.
Thank you.
I've asked George and Clive to condense their presentations into 7 minutes each, covering an introduction to their respective businesses, a background to the market, and also to walk us through a practical example. We will then have time for a question and answer session, so please feel free to submit your written questions to me throughout the presentation. So, to set the scene on what we are actually up against in our quest for income, I really do feel that I can use the word unprecedented. We have global interest rates that are the lowest they've been in the last 5,000 years of civilization. 2-year UK government bonds with a negative yield and 10-year gilts yielding 0.2%. 10-year US Treasury bonds currently yielding around 0.67%, and global companies across the board already cutting their dividends and expected to cut on average between 30% and 50% this year. Importantly, this is not a temporary cut and should be seen as a permanent resetting of dividends to lower levels. With this background, and after today's presentations, it should become clear why Carrick believe that both these asset classes, structured notes and physical property, are key building blocks that should be used to construct a diversified investment portfolio, and how they work in tandem with more traditional asset classes such as equities, bonds, and cash to achieve an optimal risk-return payoff across various market conditions. With that in mind, I would like to hand over to George to discuss why owning residential property has historically made sense and why it still makes sense. George, you have 7 minutes.
Thank you, Anthony, and thank you for the opportunity. Big welcome to everyone. So firstly, what does IP Global do? We work with individual clients, investors located anywhere in the world and help them to add the strength of direct residential property to their investment portfolio. And I'll elaborate a bit more on that in a second. In terms of the background of the business, so we've been going for over 15 years now. We were founded in 2005, headquartered in Hong Kong, because that's where we were founded. And we've got 15 regional offices across Asia, the Middle East, Africa, and Europe. And my role in the company is to overlook the Africa and the UK business. Historically, we've invested in a wide range of different property markets around the world. We're very focused on tier one mature markets now, but we've invested in 30 different markets globally and invested over $3 billion around the world. So in terms of the offering and the business model, which is really crucial to what we do and differentiates us to other property companies. So when we're working with clients and helping them to invest in direct residential property, we will provide an end-to-end service. So from the point of identifying the market, where we've done stringent due diligence on and looked at supply and demand, the underlying economics of that country, the legal structure, financing options, taxation regime, key government investment schemes, infrastructure improvements, employment nodes, and so on and so forth. And once we feel comfortable that it makes sense to acquire a property asset within that market, then what IP Global will do is we'll go and we'll take a financial position within a residential off-plan project. So what I mean by that is if a developer's building 100 apartments, let's say in London or Berlin, then we will go in before they start building and maybe purchase 50 of those 100 units. There's a few reasons we do this. One, it enables us to get access to that opportunity. Two, we get preferential pricing. And then thirdly, it means that we can get obviously exclusivity. So and clients benefit from all of that. So exclusive access, early access, and preferential terms. And once we've done that, that's the first part. The second part, the research and the bulk purchase. Then we need to package it up to make sure it's a seamless process for our clients. So what we would then do is we undertake the process of appointing the lawyers in the local market who we screen and vetted. Then we will help the client secure their mortgage. Very, very keen on leveraging in this low interest rate environment. We will manage the acquisition process on behalf of the client with the lawyers and the lenders. And then at the point of completion, we'll do the full handover, lettings, management, rent collection. And then 5-10 years later, when the client wishes to exit the investment, we will manage the resale of the property as well. Okay, and then moving on to the next slide then. So hopefully that gives you a very sort of high level overview and introduction to IP Global. So why international real estate in today's economic and political environment? There's a lot of uncertainty out there. What we do know is property is a very, very, very stable and tangible asset class, and our clients gravitate towards it as an asset for that stability. We know if you buy well in property and you do your research and you get good value in a strong growth market, then property will generate wealth in the medium to long term. For example, in London, if you bought a property and held it for any 10-year period since the end of the Second World War in 1945, you would have doubled your money. And the same can be said for pretty much any tier one key global city in the world. Now, as I mentioned earlier, is an absolutely fantastic time to leverage investments. Central bank lending rates are the lowest they've ever been, and that's great for us. It means clients can get cheap finance, which really helps to drive up the overall return on investment. Everyone is looking for a solid return on investment. For clients based in emerging markets, they're looking for a basket currency, strong currency return, and the markets we're investing in enable our clients to get that both on the rental yield and also on the capital growth side. A lot of clients buy property assets for succession and retirement planning. And then finally, as I mentioned before, property really does form part of any well-diversified and very well-balanced investment portfolio. Okay, so moving on to the next slide, I just wanted to show you a quick snapshot of where IP Global are currently investing. In the interest of time, it's going to be just a quick snapshot. So we've invested over $2 billion into the UK market, and you can see on the map there, London, Manchester, Liverpool, Birmingham, and Leeds. Those are our key cities at the moment. We are very close to launching a new project in Sheffield and Glasgow, and we've invested in Edinburgh before and looking to launch something else there in the near future. So really trying to find the value and the key growth within the UK sector. Germany's been a great market for us. We've done over 15 projects in Berlin alone, and we recently launched a new market there, Leipzig, which we're very excited about. And then our third key market currently is Portugal, primarily Lisbon and Porto. We love both markets for various reasons, which I can elaborate on in a one-to-one, but not only are they good investments, but they also offer some clients a golden visa opportunity. Moving on to the next slide. Okay, I just wanted to focus in quickly on a bit of track record in Berlin. As I mentioned, we've done 15 developments there in total, over 150 million US dollars that we've invested on behalf of our clients. And these are two examples of the returns we've generated for clients. So the top one there are the galleries. We launched that in 2017. The entry point for our clients they bought ourselves was 5,000 euros a square meter approximately, and based on current valuations we're looking at around 8,000 euros a square meter, so a capital uplift of around 49%. That's absolute, that's not taking into consideration any leverage. If we had leverage on these investments, typically clients bought with 50, 60, 70% leverage. Obviously you can double that return on equity that's displayed there. The second one is Coda, that's in Neukölln to the south of central Berlin, and we bought around 5, and based on current valuations you're looking between 7,000 to 8,000 euros a square meter depending on the project. So again, really strong returns, 25 up to say 45% absolute return on equity, and again you can double that if you're considering leverage. Right, looking on to the next project. The reason I showed those two projects is they're micro apartment schemes, so it leads very well into this, comparing like for like. Here's a fantastic new project that we've recently launched, and I'm very excited to be working with Carrick Property on this as well, who have an exclusive allocation. So the Ambassador is located in the heart of Mitte, prime central Berlin, the most central Berlin project we've ever launched actually, just off the river, very close to Alexanderplatz, very close to the redevelopment of Europa City, bang in the heart of key employment nodes, key transport nodes, and key retail nodes. 77 apartments in total, over 11 floors. It's a very high specification development with in-house amenities, communal gardens, gym facilities on the first floor, and then a cafe, supermarket, and a bakery on the ground floor. Great developer. We've worked with them once before, Adam Europe Real Estate Investment Limited. They're not just a German developer, they're spread across Europe and a big presence in the US, and we know they deliver a quality product. And this particular project completes in Q2 2022. So delving a bit deeper into this now. So as I mentioned, we have an exclusive allocation with Carrick Property and Carrick Wealth. So 14 units exclusively available to Carrick clients on the 5th and 6th floors, which I handpicked and selected with Craig Featherby, because in my mind these are the best units in the building. The starting price is there, 245,000 euros. The rental yield we're looking at achieving here is 5%, and for Carrick clients exclusively, we've put a 2-year 5% rental guarantee on the property. 2 years off plan, a 2-year rental guarantee. So this investment is packaged up 4 years essentially before a client even needs to consider any matters regarding tenancy. We're looking at leverage yields here of 12%. That's based on a 60% loan to value mortgage. In Germany, we can get up to 70% financing, to give you an idea, anywhere from 50 to 70%. Interest rate fixed for 10 years, 15 years, 20 years at 2.9%, which is absolutely crazy. It's money for nothing, really. So leverage yields, I mentioned, around 12%. Minimum equity requirement for investors for an asset like this would be at the entry-level unit, starting around 120,000 euros, spread over the next 12 to 24 months. And we're looking at an estimated return on equity here, our forecasted rate of return around 10% per annum. and that's based on a 60% leverage. And that's typically what we're trying to achieve for clients on any investment we launch. So finally, in conclusion, so the impact of COVID-19 on property, the coronavirus has created a lot of uncertainty, but it also creates great opportunity. And we know from experience that some of the best investments we've ever launched for our clients, we secured in times of uncertainty, i.e. the previous financial crisis. Fixed assets, as I mentioned, will be favourable in the short term. There's a huge amount of volatility out there, and people are a bit nervous and they want something that's safe and secure. Central bank lending rates have never been so low, which really is fantastic for our clients. Leverage highly, get very cheap financing and drive up their overall return on investment. Very strong rental yield, which is anti-inflationary, which is what people want in this type of market. Finite supply of property. So I know it's cliche, but there is a limited supply of land, a limited supply of property. And COVID-19, if anything, will create a lack of supply even more so in the key markets we're investing in, as a lot of developments won't come out of the ground for those developers who maybe haven't secured their development finance, because a lot of banks have changed their lending arrangements. And then finally, with any property investment, we need to take a long-term view, medium long-term, 5, 7, 10 years. And that's what we're focused on. So despite a bit of short-term upfront volatility in all markets, if you invest well in property and hold it medium to long term, you'll generate a very strong return. Thanks for the opportunity, and I will now pass back to you, Anthony.
All right, fantastic, George. It really was a great, concise overview of the market. I mean, from my perspective, when I was doing diligence on IP Global, besides your phenomenal track record from a returns perspective, what really resonated with me, and you've mentioned those points, but I think it's worth saying them again, is the deep level of diligence that you do on the individual country, the city, and really, all the way down to the street, the developer, obviously, the fact, that you have real alignment of interest, skin in the game, by putting your own balance sheet at risk, and then that end-to-end service that you spoke about on the letting side, on the mortgage side, that really, to me, that all combines to create an extremely compelling package. So thank you for that. I would like to move on now to structured notes, and in particular, a subset of structured notes called an income note. So Carrick have been using income notes for 5 years now, and we're going to be using them for the foreseeable future. Clive, over to you, please, if you wouldn't mind walking us through the world of structured notes.
Thank you very much, Anthony. It'll be a pleasure, and thank you everyone for dialing in or logging in today. So much appreciated to have the opportunity to talk about something as exciting as structured products to you all. But just by way, a bit of background to IDAD. So my first structured product, I think, was when I was at Citibank in 1992. So I've personally been sort of working with structured products for almost 30 years. But IDAD was set up just under 20 years ago. Head offices in Hampshire, in Petersfield. We've got offices in London, Cape Town, in the UAE, and I guess we work with sort of 20-25 different investment banks. So pretty much everyone, in order to deliver investments that are appropriate for different target audiences. So whereas historically, we'd always worked with family offices, with fund managers, with institutional investors, the last 10-12 years we've worked in a much wider market, delivering investment products that are suitable for different target audiences. So typically our sort of target investor will be pre, or sometimes in the first few years post-retirement, broadly looking for lower risk opportunities, but still targeting reasonably attractive returns without going crazy. And I guess the key thing, one of the key messages with IDAD, we're a privately owned company. I guess our real strength is trying to use our expertise and experience to deliver better products for investors. So financial services sometimes gets a bad name because it's people using their kind of increased knowledge or greater experience, sometimes to the detriment of their customers who don't have the same level of understanding as they do. So if we look at our track record, I mean, I think you may have to sign a disclaimer if people want to look at our website, but we list all our products, I think, for the last 12 years on our website. It's a very comprehensive information. We've launched, over 1,200 products in the sort of wider marketplace now. Some of the products we've launched, we've had a few lose money. Generally, I think almost exclusively some of the very high return, high risk products. There's nothing magic. Some of them have lost money, but actually, what we always do is every quarter is look back at the average returns. If an investor had invested in all of the products, what sort of returns they would have received. Typically it runs, at the moment it's running just over 7% a year. So all the products that have matured, actually the annual returns would have beaten even the S&P 500 index at the moment. So a strong track record and very transparent. People often look at structured products. If we look at the next slide, it's trying to position how structured products work. So on the one hand, I guess people look at traditional equity investment where you get 100% of the rise and the fall in equities or in a fund. I guess passive investments, tracker funds are very popular at the moment. I'm based in the UK, so I tend to look at the FTSE 100 index, which is interesting but sometimes depressing. The index was pretty much at 7,000 points in 1999. And it's now at kind of 6,200. And actually, over the last 20 years, an investment in the FTSE 100, would have seen investors as lose money, compensated to a degree by the 3 or 4% dividends they'd have received each year. But obviously, that would have been suppressed by any charges. At the moment, I mean, Anthony touched on it earlier. Interest rates are astonishingly low. Obviously they've been negative in the Eurozone for a while. There's talk in the UK with the Bank of England, preparing people for negative interest rates. So if you put your money in the bank, you're paying for the privilege. It's literally, you'd be better off putting your money in a strong room in your basement and posting a guard with a machine gun outside. In dollars and sterling now, 5-year base rates or swap rates around 0.3% per annum. So any returns over and above that, going to be attractive. A lot of you are in South Africa. We're looking at some rand denominated products at the moment, but even interest rates in rand have fallen significantly and are likely to fall further. But what structured products do is kind of sit in the middle of, between kind of full exposure to equity markets and the security of a fixed rate bond. So we have capital protection features. So although investors aren't getting, 100% capital protection, most of the products you'll see have features that mean as long as the capital protection barriers haven't been breached. So for example, over a 5-6 year period, markets haven't fallen by 40% or more, the capital is protected. And then we target, as an attractive a level of income as we can. And again, that income's paid out even if markets fall. So I guess structured products sit as a kind of halfway house between, on the one hand, a bank deposit, and on the other hand, full exposure to equities. People sometimes say to me, what's the secret with structured products? And what I tend to say is, look, there's no kind of Harry Potter magic. If we look at one of the key elements that's sometimes overlooked with any investment product. On the one hand, the structured products, typical, the costs embedded within the structured product might run to sort of 1.5% tops over a kind of 5 or 6 year period. So significantly cheaper than buying a traditional fund. So your starting point is less money's going out in charges, and then it's the ability to design products to match precisely what the investor requirements are. So a lot of you tuning into this webinar are probably looking for a decent level of income, but not trying to take on undue levels of risk. We offer all the products are liquid, so if you need to get out of your product early, although the terms are designed in such a way that investors should try and stay in for the full term. The products are liquid, they're priced every day, so if you need to get out, you can get out, although you will see prices move around quite a bit. The terms of the product are designed for the products to be held for the full term. Just a quick look at an example. So at the moment, as Anthony said, we've been working with Carrick for the last few years. This is a product which I think actually closes today, which we've been running with Carrick. This is a product that's issued by CIBC, so Canadian Imperial Bank of Commerce. It pays a coupon of 7% per annum, which is paid each quarter, so 1.75% paid every quarter. So that's paid out as income. The investment term has a maximum term of 6 years, but it may mature early. So in order to help boost the coupon, we have a feature, an auto call feature, if you like, which means that if the underlying stock markets are above their level, their starting level, they don't have to grow at all, but if they're above their starting level on any quarterly observation after a year, the product matures. Investors get their money back and get the opportunity to reinvest on terms available then. And that feature actually helps boost the coupon. This product pays the income as long as the stock markets are above 75% of their starting level. So it's not 75% growth, as long as they haven't dropped by more than 25%. If they have dropped on any quarterly observation by more than 25%, then they can be caught up at the next quarter or any subsequent quarter, assuming the stock markets have managed to struggle back above that 75% level. We do a lot of analysis on the products before we launch them, so we do a lot of stress testing, kind of stochastic modeling, but also we do a kind of back test to give us a full 10 years worth of scenarios of what would have happened in the past, so a 16-year back test. In the case of this product, for example, and this, these details are always published with the product literature. The average return on this product over the last 10 years, investors would have received 6.99% per annum. I think there were 11 occasions where the product got to the final observation and missed the last income payment. But on none of the occasions where capital had been lost, so investors would have got all their money back and pretty much every time got the full 7% year income. I know you probably have quite a few questions which Anthony's going to pick up on now. Some of you have probably invested in our structured products already. Thank you very much for that. And one of the reasons we like working with Carrick is actually they've got very professional advisors and support teams. So if you have got specific questions, obviously they'll be able to help. But that's IDAD and the wonderful world of structured products. Thank you very much for your time.
Thanks, Clive. So in summary, income notes are promised by a bank to pay a defined interest rate as long as certain conditions are met. I mean, I can certainly say that notes play a vital role in Carrick's portfolios. And as an example, as you know, I did an analysis of our performance of our income notes over Q1. And out of 55 notes that we have in circulation, 49 notes paid their coupons. That includes, obviously, the March crash that we had due to COVID. And the 6 that narrowly missed the coupon are highly likely to catch it up again in the future due to that memory feature that you did describe. 2018 is another great example. Equity markets were down on average 8% in 2018, and every single one of our income notes paid their coupon in 2018. So I think, in my mind, in essence, what that really says to me is that these notes are behaving and performing exactly as they were designed to behave. So really, really promising and comforting from that perspective. Okay, I think let's move on to some questions. I see that there have been a number that have come through, so thank you very much for that. I'm going to focus on some of the more common questions. If I don't get to your particular question, please forgive me. I will get to you on an individual basis after the webinar. Okay, so there's a number of questions about returns. George and Clive, obviously a very relevant question. Clive, you've spoken to us now about expecting, around about that 7% range in US dollars from the income notes. George, you did also speak about expected returns, but I think let's elaborate on that, because it's obviously a key factor to consider when investing in your asset classes. So George, I think if you wouldn't mind going first, and if you could just elaborate on the returns aspect, please.
Sure. So if we look at the rental yield, the rental return, first of all. So it doesn't matter which market it may be, UK, Germany, or Portugal currently, we can achieve yields across those markets of between 4 to say 7%. The upper end would be for the UK. Obviously, the more prime the city, the more prime the location, the yield would be slightly lower, closer to the 4. So that would be your gross yield unleveraged. Times those by 2, we're looking at leverage yields. But ultimately, what we're looking to do, Anthony, is to structure investments for clients, property investment, where they will leverage, let's say, at 50, 60, 70%, take advantage of cheap lending, and have a solid rental return, which covers the cost of the financing, all of the other operating costs of the property, i.e. service charge, levies, ground rent, lettings and management fees, so on and so forth, with a little bit of profit rent left over. So they're paying down their mortgage over a period of time, having a positive rental income that accumulates in an offshore bank account for them. That's essentially what we're trying to do on the rental side. So on the capital growth side, it really varies, but we're trying to target markets where you're getting 4 or 5% annual capital growth, so absolute growth. And again, if you leverage that, then it starts doubling, tripling, depending on how much leverage we can get. But our target rate of return on any investment, after all costs, taxes, so on and so forth, would really range between about 10 to 15% per annum.
Okay, I mean, clearly very, very appealing returns, but we all know that good returns come with risk. What are your key focus points when you are bringing a project to market?
Yeah, good question. So going back to our model, we've got a big research function. We have 10 investment managers, stroke analysts in-house who are responsible for different markets. So they'll look at market risk, which obviously without a crystal ball, we couldn't predicted COVID. Bill Gates did, but not many people could. So for black swan events like that and the plummeting of oil prices, no one can forecast that. But you can really do a big deep dive beneath the bonnet of any market and look at the fundamentals that exist there. What's the legal structure? Is it favourable? Is there a lot of protection? When we're looking at developers, are they well capitalised? Do they have a strong track record? Are they overly leveraged? Are they doing a development based on planning conditions which may never be granted? So on and so forth. And that's really the key risk, I suppose, any property development is the developer. So we need to be very stringent to them and make sure they're safe and they're sound. The second one, and on that, sorry, when we take a position in the project, we're taking an upfront position on our balance sheet. So again, we have to be extra cautious there to make sure we're working with the right developers, because ultimately we've got more exposure than an individual client has. The second one would be, which is very relevant now actually, is the tenant risk. Your rental return is guaranteed by your tenant, obviously, and the way in which we mitigate that, because tenants can default. When you take out a new tenancy, or a tenant takes out a new tenancy on your property, you can get rental protection in place, landlord protection, which is good, a couple £100 a year, and you're protected for any tenant defaults. Secondly, nip it in the bud at the start, screen the tenant properly, get a good tenant with good references, with a strong job, good income, a previous track record, and then you can mitigate most of those, up front. So those are probably the two key risks, I would say.
Okay, thank you, George. Clive, key risks on your side that you look at?
Yeah, I guess really there are a few key areas. So the first one is obviously the issuing bank, whoever the counterparty is. So we work, we pretty much work with just major banks. So we'll look at their kind of formal credit ratings, but also something called credit default swap levels. So this is a kind of market indicator of risk, which is a live indicator of risk, and gives you an idea of what additional kind of risk premium the bank should pay. So we pay close attention to that. Also, market intelligence. I was saying to someone the other day, we never issued any products backed by Lehman Brothers. In fact, we stopped using any US banks in 2008 and didn't start again until the end of 2009. So I get frustrated sometimes when people say, "Oh, we didn't see this or that coming." Actually, if you work in particular markets, it's tough not to see things coming sometimes. So as a rule, we're very careful, and again, it's all about suitability. The same with the the underlying stock markets we use. We use only major stock markets, principally for these income notes. Certainly, we would only use stock market indexes, stock market indices as the underlying investment link, and that's because you may have individual stocks that disappear completely, companies go bust or sectors suffer. Whereas if you've got a broad-based index, actually, that risk is diversified considerably. And ultimately, all we're looking for is underlying investments that don't drop by 40% as a rule over 6 years. We're not looking for strong performance. So when investors say, "Oh, maybe you should invest in this sector or that sector," great. We're not looking for growth, particularly in the underlying links. We're looking for stability. So key in terms of the risk, and then looking for kind of appropriate returns. At the moment, I mean, the product we just looked at is paying a coupon of 7% a year. Right now, I think we'd struggle to probably match that, but at the moment, anywhere between kind of 5 and 7% a year in dollars is good sort of a risk-adjusted return. But as markets change, there's more risk in markets or interest rates move. Obviously, that rate range will move up or down. But yeah, risks at the forefront of everything we do.
Okay, fantastic. We've got time for one more question, and this is a COVID question that's come from David in Ghana. So thank you very much for that. He's saying COVID-19 has brought a whole new dimension to the landscape. If you could please comment on what has changed in your investment world over the last few months, and what challenges and opportunities have been presented. So great question, thank you. George, if you wouldn't mind picking that up.
Yeah, I mean, I touched upon it earlier. So the key, the key changes that took place in lockdown, nothing was happening anywhere really in the world from a property transaction perspective. Transactions were still going through, but minimal amount, because all the key parties weren't there. The agents, the lawyers, developers weren't on site. So we saw a couple of months really where not much was happening. So what's that resulted in? It's resulted in a delay in project completions. What I think we'll see moving forward is there'll be a shortage in new developments coming out of the ground in some markets, because some developers are too overly leveraged and banking land which they plan to develop, and the bank's risk appetite to do a development loan now has probably diminished or disappeared completely. Tenant side, I touched on that. There definitely has been a bit more tenant risk and volatility over the last few months, and probably will be the next few months. We get around that by putting rental guarantees in place for clients where appropriate to mitigate any risk associated with that. And then I think obviously the interest rates have come down, which is favourable for property as an asset class, and not favourable for cash in the bank, as you mentioned. And moving forward, residential property will continue to do well. The big losers in all of this, for obvious reasons, are retail and commercial office space, because no one's going to the high street because they can't. People are shopping online, and not many people are in the office at the moment. And this paradigm shift, which I don't buy into the whole world changing after this. I think there will be some changes for the good, hopefully. Human beings naturally are creatures of habit and will gravitate back to what they did before. But I do think a lot of people will reflect on, okay, I've got staff working remotely, my revenue or my profits are down maybe by 20-30%. My office cost is one of the key components that of my operating costs for my business. Let's have a bit of a rethink about whether we actually need that big shiny office in London, for example. So I think the built environment will have an impact after this, and the office sector and the retail sectors will be badly impacted.
Yeah, I guess the residential sector, you know, I was on Wall Street back, you know, when the Twin Towers came down. I was there through the global financial crisis. And one thing I realized through that is, you know, people still need a roof over their heads. Life does carry on. So, you know, I agree with you completely on that. Thank you for those comments. Clive, in your world, obviously credit spreads have blown out. Volatility, you know, went to 80 and has significantly come back. Interest rates are low. How does that all work in your world to actually, you know, carry on bringing good product to the market?
I mean, I guess the biggest thing is the disparity in pricing. So, you know, as risk increases and volatility increases, in theory, investors are rewarded for taking on the equity risk, you know, where there's more volatility. But, you know, one of the biggest differentials, which has been exacerbated by you know, the geographical spreading of all the guys who work at the banks. The traders are at home, the structurers at home, you know, the risk guys are all at home, and so we've seen huge disparities in terms of the pricing. So, for example, you know, the product we were looking at earlier was paying 7% a year income. You know, we could price that with some banks and they'd be paying 3% year income. You know, some paying 4 or 5. And you know, the disparity between the different issuers has been wider than ever, and if anything, that's been a terrific opportunity for us, because, you know, we work with a lot of different banks, so, you know, we really can you know, kind of pick and choose and match the products, you know, that are suitable for clients, you know, from bank to bank. And you know, obviously, you know, Anthony and the advisor at Carrick and customers as well will see actually there's quite a rotation. You know, it's not just a roster of, you know, Bank X, you know, prices this product particularly well and gets all the business. At the moment, there's been a lot more movement there. Outside of that, just you know, I guess really, and a lot of industries are affected by this, it's a telescoping effect. So whereas a decision, you know, might have been made in sort of 30 seconds on a trading floor with, you know, 5 guys, you know, or girls chatting together, now it's kind of a Skype call here and a, you know, phone call there and an email there. So processes have taken a lot longer, but, you know, ultimately it's you know, the real value of being independent, really. You know, if I was working at a bank and we were pricing particular stuff poorly, we're stuck. You know, it was actually you know, it's been a good opportunity for us. Yeah, crazy times, but seems to be calming down.
Absolutely. Okay, great. I think we need to leave it there for today. Certainly lots to think about, and 2 extremely compelling investments that are created to complement the more liquid and traditional asset classes in investment portfolios. Thank you to everyone for your time. I hope you found it interesting, and I look forward to seeing you again at our next webinar. Please stay safe over these challenging times. Goodbye.
Thanks very much. Goodbye. Thank you.